Hey guys, welcome back to another video. Today we're going to be talking about the tips and tricks that you can use as a business owner to negotiate your term sheet that you receive from a bank. So this is advice coming from the lender's perspective. I used to work for a large Canadian bank and I used to see some of these things done effectively by borrowers and with very little pushback from the bank or the risk department. So these are the 5 areas of the term sheet that you can negotiate to reduce your cost and your interest rate. So most people believe that the moment that you sign a term sheet, all the negotiation is done. I've signed the term sheet, it's gone to credit, and now they're approving that term sheet, and therefore the terms are set in stone. But remember, a term sheet's non-binding. What is binding is the offer of finance. So up to the offer of finance, you can continue to negotiate terms. And the reality is the best time to negotiate the terms of a loan are not at the term sheet, because there's no invested time, there's no costs, there's no resources dedicated to getting that deal underwritten and done and approved by risk. The best time to do it is actually when the underwrite is complete, when the loan is approved, and it's at the offer of finance stage, because then those resources are committed and the relationship manager wants to see the deal cross the line and get funded. And that's the best time to push on certain areas of the term sheet. Now, the areas with limited flexibility, which are traditionally the areas that are critical to the underwrite, cannot be negotiated. And, I'm not suggesting that you push back on these because usually it will re-trigger a credit underwrite and just delay the ultimate funding of the loan. So those are typically the total leverage of the loan. If the bank says I can only give you 1.2 million, most likely they're not holding back. It's not like it's in their interest to, right? The relationship manager gets compensated on the total value of the loans that they fund for their sales budget. And so they wouldn't want to hold back the amount of leverage that they can give you. So typically the total leverage, the 1.2 million or the 5 million that the bank says they're going to give you, that's probably what they can afford to give you. The same thing applies for the term of the loan and the amortization. Amortization is a very kind of critical risk factor for the risk team and for the bank, and they're not willing to change amortization usually. So if they say, I'm comfortable in giving you a 5-year amortization, that's most likely where the bank's going to be. There's not a lot of room for negotiation. And same thing with financial covenants. Most banks will ask for a debt service coverage ratio, a leverage covenant, a senior funded debt covenant, whatever the case is. And those covenants are critical. That's really the philosophy of the bank when it comes to their risk policy. So it's very difficult to push back on those covenants. Now, there are 5 areas where you can push back, whether it is at the term sheet stage or where I would recommend, and you have more leverage, at the offer of finance stage to take advantage of their already committed resources to underwriting your deal. And the 5 areas are the interest rate. Most people think that the interest rate is set in stone for the term of the loan, but you can negotiate changes in the interest rate over the course of that loan relative to the change in the risk level of that business. And I'll talk about that in the next slide. The fees, the commitment fees, the annual fees, the prepayment penalties, all of these invisible costs that are usually not relevant to the core underwriting quality of that loan, the bank is not going to negotiate aggressively on. So you pushing and trying to reduce those invisible, adjacent fees is a great way just to reduce some cost to you as the business owner over the course of that loan. The same thing is with the funding conditions. Banks are notoriously slow. They don't know how to manage the clock, so you have to manage the clock for them. And there are certain things that you can kick out to make a funding condition so that you don't have to get it up front to get the deal approved, but you have to get it before the funds are sent over to you and funded. So that's another thing I'll talk about. Personal guarantees, a very sensitive topic. People hate personal guarantees. Unfortunately, most banks will ask for personal guarantees if the loan is unsecured, but there are ways to reduce the limit and the exposure that you have to a personal guarantee, once again, over the course of the loan. So it's very similar to the interest rate pricing negotiation tactic. And lastly, cash equity requirements. Banks usually ask for skin in the game to get a deal done. They want equity in the deal. They want equity in the property. They want equity in that business that you're buying. But there are certain ways that you can get equity-like structured solutions that aren't truly cash equity to you to save your money and still check off the skin in the game box for the bank's risk team. So let's focus on number 1. So interest rate pricing. So pricing is a direct correlation to the risk level of that borrower. So if a bank views you as risky, they're going to price your loan higher. And if the bank views you as a AAA client, then obviously they're going to give you a more cost competitive interest rate. Now, traditionally, the highest point in the risk curve for a loan is upfront when the loan is funded. It's the highest point in the loan's outstanding balance. It's when the borrower is unproven, doesn't have a proven track record with the bank. And it's also the point in time where your earnings relative to your debt are at the highest level. But as the loan gets paid down, as you pay down that loan over 3, 4, 5 years, the loan balance declines, and hopefully maybe your earnings just stay flat, or maybe they even grow because you're a growing business. And so the risk level of that relationship between the bank and the borrower changes. It's not the same risk level. And traditionally, what you most likely see is that the risk level declines. So why does the interest rate stay the same throughout the term of the loan? Well, it's because no one really points that out or negotiates a pricing structure to compensate the borrower for the reduction in the risk level. So what you should be doing is you should aim to negotiate a pricing grid tied to the performance of either the debt value, the outstanding debt balance, or financial covenants like a senior funded debt ratio or a debt service coverage ratio. And as the loan gets paid down, or as the outstanding balance declines and the covenants improve, there should be pricing reductions. The spread should reduce by 25 basis points for, an increase in the financial covenant, or a 10% decrease in the outstanding debt balance. And what that does is it saves you money over the term of the loan. Not up front, because up front it's difficult to negotiate the interest rate too much on the upfront, because the way the bank views your risk is the way they're going to price that loan. But over the course of the loan, the bank can't really push back and say, whoa, we want to keep that price the same. Well, hold on a second. My risk is declining. So therefore, I want to see stepped down pricing grids. And so that's what these two options are. So in this example here, this is a financial covenant pricing grid. So say, for example, the senior funded debt to EBITDA level for this business is 4 times, 4.00 today. And their cost is cost plus 3.75%. Well, the moment that their covenant improves, and in this case, because it's a leverage covenant, you want to see the covenant go down because you're paying down the debt, then you receive a 25 basis points decrease when you hit this level. And say, for example, you pay down the debt aggressively, or you sell off a property and quickly pay down the debt, and all of a sudden, your senior funded debt to EBITDA covenant is 2.8 times relative to the 4 times it was on day one. Well, then, I should get a 1% reduction in my cost of money because, the risk level has changed. So this is a very easy way to save money on the interest rate side. In the second example here, now we're looking at the outstanding loan balance. And I typically like to do this pricing grid because it's simpler to understand for all parties. As you reduce the term of the loan, and so long as you're within your covenants, on an annual basis, if the loan balance reaches less than $800,000, then the interest rate on the loan will change and it will decline by 25 basis points. Same thing, you reduce it by another 10%, another 25 basis point savings. And so if you can keep reducing the rate of the loan relative to the cost 3.75% on day one, you're now maybe at cost plus 3%, which on a $5 million loan is $15,000 a year in interest that you saved 4 years down the line. So this is a very easy way to save costs on the interest rate. Now, lender fees and penalties are a very interesting area. The reality is that most lender fees are not critical to determining whether you're approved or declined for a loan. The reality is lender fees are just pure gross margin extras that the bank will charge you as a client. And so the bank loves these extra fees because there's no associated cost with them. Whether I underwrite the loan or I don't, I get these fees. And so, from a borrower's perspective, you can easily negotiate these fees because not a lot of lenders are going to push back on them. And just to kind of explain the landscape once again, you have the risk team that approves or declines the loan. But you, as the borrower, are most likely going to be dealing with the relationship manager or the account manager or the commercial lender. And that commercial lender is not compensated on these fees and penalties. They're compensated on getting the loan approved and funded. their key driver compensation is the total loan value that they fund. Maybe it's a sales target of $40 million in loans over the fiscal year, or it's gross margin generated on the interest rate. So that's why in this earlier example, it's very difficult to negotiate the interest rate on day one when they fund the loan, because a lender is going to get compensated on that. And the same thing, the total value of that loan is what they want to give you the most. So they're most likely going to give you a lot of what they can. But these lender fees are discretionary things, and they're usually secondary in the bonus compensation plan, and sometimes even lenders don't get comped on the fees in general, so they won't push back when you push back on these areas. So this is a really good way to save a few $1,000s throughout the course of the loan, once again, which is real money to you as a borrower. So there are a few areas. The first is the commitment and the application fee. This is typically the fee that gets charged upfront when you sign back a term sheet or you fund on the loan, right? A lender is going to ask for maybe 1 or 2% of the loan value in the form of a commitment fee upfront. Now, again, this upfront fee sometimes will be included in the lender's bonus plan, the relationship managers, but it's not do or die. And the difference between them getting the deal approved or you negotiating a 20% decrease in that commitment fee, they're all obviously going to just say, sure, I'll accept that 20% decline just to get the deal through, because funding the loan is going to get them more value for their compensation plan and get them paid. And that's how you want to negotiate and think through lender negotiations. At the end of the day, the person that you're dealing with is a sales guy, is someone that is selling debt to you. So take advantage of what they care about. And these are things that they don't care about. So for the commitment and application fees, if they give you a $25,000 commitment fee, you can easily shave $5,000 off that and sign it back at $20,000. They won't even blink an eye. Maybe even $15,000, but at $15,000 they'll probably push back a little bit. But still, you can save several $1,000s on the commitment fee. The same thing with the annual and quarterly fees. These are fees that are charged to the borrower on an annual basis when the lender reviews and runs calculates the covenants on that loan. It's $500 a quarter, maybe $2,000 a year, whatever the case is. Cut these by 25-30% easily. Sign back the term sheet or the offer of finance, and instead of $500, you sign it back at $250 a quarter. And obviously over 4 quarters, that's $1,000 to you in savings. And for the lender, they don't care. They'll easily accept the pushback. So another easy way to negotiate. And then the last two here relate to the loan balance and prepaying it. So lenders care about prepaying the loan because they don't want you to, easily borrow that money and then just pay it back, almost like a revolving facility. Term loans typically have up to 10% of the outstanding balance can be prepaid in that year. But if you want to pay more down, if you want to pay, say, for example, 50% down, then outside of the prepayment allowance, the 40% in that example, there's an interest rate penalty that is applied for you to prepay that money. And it's typically 3 to 6 months of interest associated with that 40%. So that's significant. So there are 2 ways you can approach prepayment areas of the term sheet. The first is bumping the allowance, which from 10% to 15% or 15% to 20% of the outstanding balance of the loan to prepay without penalty. And then the second is to push back on the penalties of the prepayment. So, if the lender is 6 to 9 months of interest on that prepayment, you can push back to 3 to 6 months of interest. Or you can even say, hey, listen, I'll pay only 3 months of interest up to X, and above that, then I'll prepay 6% interest, or whatever the case is, so that, you try to, really change the term sheet to your advantage, allowing you to pay more down quickly without those penalties. So these are some easy ways to save you a lot of money. And usually when I'm negotiating for one of my clients to the bank, I push back on these areas and I'll extract at least $5,000 to $10,000 worth of value over the course of that loan easily without the bank pushing back or hemming or hawing or anything. And this doesn't trigger a credit underwrite because these are, profitability considerations, but they're not core to the underwrite in terms of determining whether the borrower can borrow the money or not. So again, these are really good areas to focus on at the offer of finance stage when they've already invested a ton of time. So personal guarantees. So if you're a new customer or you're borrowing unsecured funds, it's unavoidable that you're going to have to sign a personal guarantee. So It's very difficult to negotiate away a personal guarantee unless you have a fully secured deal or you're a highly reputable high net worth client that the bank wants to win over. But in most instances, for a traditional business owner, removing the personal guarantee is difficult. However, you can reduce the overall limit over the course of the loan of that personal guarantee. So what that means is, as the loan performs and the business pays the loan balance down, the risk level, similar to the interest rate, declines. So the risk level declines. So, really the unsecured portion or the risk that the bank carry declines over the course of the loan. So similarly, you want to change the personal guarantee to reduce its limit over the course of that loan. So I'll give you an example. So say, for example, you're buying a business for $5 million. And with that business is $3 million worth of equipment. A bank is usually going to start off negotiations by saying, hey, I want a full personal guarantee on the money that I'm giving you, which obviously, they're secured with $3 million worth of equipment. So you can easily push back and saying, no. The unsecured portion for the loan is only $2 million. So that's what I want. So you always need to think about, from the bank's point of view, how unsecured are they? If you're borrowing a cash flow loan and you're not buying it, and it's purely for goodwill, then the entire cash flow loan is unsecured, and therefore they can ask for a full personal guarantee. But if you're buying a business for $5 million and you're asking for $5 million, and with that business comes assets, real assets, you want to make sure to understand the value of those real assets and then push back and say, no, I'm limiting the PG to the gap between what's secured and unsecured, which in this example would be $2 million, okay? And then typically the best way I see that you can negotiate a personal guarantee is you want to tie that personal guarantee to the balance of the loan. So what that means is that instead of saying, and most banks will put in front of you, sign a full personal guarantee equivalent to $2 million, equivalent to $1 million, equivalent to whatever, and they'll peg a number, well then that number is fixed throughout the course of the loan, even though the loan balance changes or the delta between what's secured and unsecured changes. So the best way to do it is just to say, no, I'll accept that $1 million, but don't fix the value, make it a percentage. And so the best way to do it is to say, I'll sign a personal guarantee equal to 20% of the outstanding balance, which is equivalent to $1 million for you today. But as the loan balance declines, that 20% limit now changes. So if I reduce that loan by 50%, well, really, the true personal guarantee, 2 years down the line is only 10% instead of 20%. So you're reducing your exposure on the personal guarantee by changing it from a fixed amount to a percentage amount. And that, again, doesn't change the core underwriting principles for the risk team or the borrower or the lender. And so from the borrower's point of view, it is real to you because you're saving and protecting yourself over the term of the loan as you reduce that loan. And then the last thing to do is you can also even push for a PG removal. So once the loan balance declines to a certain amount, and I usually kind of peg it at about 50%. So if I borrow a loan for $5 million, at $2.5 million, I've reduced the loan by 50%. And so you've lent to that business and you've seen a 50% reduction in your exposure. Why do you still need this PG? You most likely have asset value that's fully covering the outstanding balance, so I want the PG removed. So if you can effectively determine the delta between what's secured and unsecured, find that value, and then time the value of that loan pay down relative to when it's fully secured. So in this example, same thing again. I'm borrowing at $5 million. I know there's $3 million worth of equipment. The moment that I fully pay off the $2 million in unsecured exposure, I want the PG removed. Again, how is the bank going to react to that? They might say, oh, the value of that $3 million has changed, but realistically, you're going to replenish the value of that equipment to support the business. So you're going to buy new equipment that's going to be part of their security package to replace the old equipment. So ultimately, you can push to get that PG removed once the loan balance equals the exposure of the asset base, which is $3 million. So the last thing to keep in mind, and I kind of added it here at the bottom, and what I'm seeing nowadays in the market, and this video is being recorded in 2021, banks are really hot, the M&A market's really hot. If you're a financial investor, in this current era, removing a PG is even easier because a lot of banks, when they hear private equity, or they hear family offices or, private investment, private investors hate PGs, and it's commonplace that private equity groups will never sign a personal guarantee. So if you can kind of position yourself to say, hey, listen, I'm private equity backed, we never sign PGs. Like, why are you giving me a PG? Maybe the bank will back away from pushing on a PG. But if you're an independent business owner, unfortunately, you don't receive that same treatment. So, for most business owners, the banks will be aggressive in pushing on PGs. But if you're a financial investor, they are more amenable to even removing the PG fully because, he's going to be a financial investor. He's going to buy multiple businesses with us. The value of our relationship is going to increase over the course of the loan. So I don't really want to scare this customer away. And so the banks fight and typically bend more over for a financial investor versus just an entrepreneur that owns one business. So let's talk about conditions of funding. So lenders lack a sense of reality when it comes to timing. They prefer to ask for all the information up front during the credit committee review and the underwrite. And this typically slows things down if you're waiting for reports or things that you've ordered. So you need to understand that there are some things that are required for funding that can be made a condition to funding, and you don't have to get upfront. And this is a really good way to manage the clock and speed up the underwrite so that you're not waiting around 4 months for a funding, but can get the funding done in 2 months instead. So these are really good ways to, and there are certain areas where you can negotiate this. So the first one that I typically always push back on is if they give you a term sheet and they say, hey, listen, if you're going to sign back this term sheet, I'm going to require you to pay me $25,000 or 1% of the outstanding loan value today so that I can start the underwrite. What you can usually push back on is say, fine, I'll pay you that amount, after I negotiated, obviously, going back to number 2 in this video, but I'm not going to pay you that today. I'm going to pay you that on funding so that you're kicking out the payment of the commitment fee from today when you're at the term sheet stage to the day of funding when the loan is approved and you're really certain that the deal is going to go through. And so what that does is it doesn't stretch you from a cash flow perspective to put money up front before the credit loan is approved. You just kick it out and you say, no, the application fee is going to be paid once the funding goes through. And most banks will not push back. The same thing is with the financial statements. If you're a borrower or you're looking at a customer that has notice to reader statements, most banks will say, no, I cannot lend on notice to reader statements. I need review engagement statements. Well, instead of waiting 4 weeks for the accountant to go through that NTR to review engagement conversion, the best way to do it is fine. I'll underwrite on the NTRs, but I'm going to require the review engagements to be completed before I fund the loan. And I require that those review engagements reflect or similarly reflect the numbers that I'm underwriting on today, which are NTRs. And so that way you kind of skip over oh no, I don't have the quality of financial statements I need to get the loan. Well, no, I'm going to go get them, continue to underwrite the loan, keep going through this process, don't waste time. I'll go to the accountant and get them and give them to you before you fund. So you're not running the risk of landing on NTRs. You're going to get them. And you also have an out if the NTRs come back and they're really bad on the review engagement format, there's fraud or whatever, then the bank has an out to say, well, no. They're not similar to the NTRs, therefore I'm not funding the loan. But from the borrower's point of view, if you're certain that your NTRs are not going to change relative to when they go through that conversion process, then why not kick it out to a condition of funding and keep the process moving, manage that clock effectively. The same thing is for quality of earnings. So QOVs, or quality of earnings, are financial reports that an accountant will prepare to support the EBITDA analysis or the cash flow analysis when you're buying a business or an asset. And so usually that takes 4 weeks. It's very similar to a review engagement process in terms of time. And so, why am I waiting for that quality of earnings to be completed upfront before the underwrite has started and before we've gone to credit? Well, underwrite the loan on the assumption that the EBITDA is going to be what it is and what we're guiding for today. And then once we receive the quality of earnings before funding, it needs to substantiate and confirm that value. And if it doesn't, then a credit review gets triggered, but you're not holding up the process for 4 weeks up front. You're doing it on the back end when there's already invested resources, risk has seen the deal, you've already gone through a few steps and you can tweak the deal if the QOV comes back different. Again, these are all different reports that you typically get for different deals. So, for NTR to review engagement conversion, businesses in general need to get a review engagement, so you can make that a condition. For quality of earnings, this is an M&A deal. For environmental reports, same thing. If you're buying a piece of real estate, banks can ask for an environmental report. Don't wait for the bank to start the underwrite. Once you get the environmental report, say, no. The seller has said that there's no environmental issues. Let's take their word and let's make the environmental report a condition to funding. Let's not hold up the deal. Boom, keep the process moving along. And the same thing with lease renewals or any type of customer, supplier, landlord negotiations. Just say in the condition precedent or the condition funding that, before funding, I'm going to deliver to you a negotiated lease that will be within X amount of dollars of cost per annum. And that way, the bank can peg a number in their underwrite to the lease renewal. And obviously, if you come in at that level or below that, it doesn't change their underwrite assumptions, and therefore the loan can be funded. But if it comes above that, then again, it will trigger a credit review, and you tweak the deal a little bit more and get the deal across the line that way. But you're not wasting 4 weeks or 8 weeks to get to negotiate that lease. So conditions of funding is an effective way to manage the clock from the borrower's point of view. And I can tell you now, being on the M&A side, it's really frustrating dealing with banks that are slow down the process because they're waiting for this or that or this. No. Here's what we have. Here's what we're taking at face value. The seller is reputable or the vendor is reputable. Let's just push through. If it obviously comes different, then you have an out to say, yes, I'm going to change my loan underwrite. But if it doesn't come back different, then we didn't waste 4 weeks waiting around to get that report. We just continued on in the process. So here's some proposed wordings using those examples. So in the term sheet, you can push back and say, instead of the bank saying we require a quality of earnings up front, you can say, no. A borrower is to provide a quality of earnings prepared by a reputable accountant supporting the X amount of dollars in EBITDA that we're assuming today prior to funding. So that way they underwrite on the assumption that $1 million in EBITDA is available to them. And if the report comes back and confirms that, then boom, you can move forward and just fund the loan and keep the process moving along. Here's another one. Borrower is to renegotiate a lease agreement for the property at ABC 123 Road for a minimum of 3 years at a maximum base rent of $200,000 per annum. So if I come in at 190, I come in at 200, then obviously you're underwriting with the assumption that it's going to be in that cost range. If it comes back more, then it triggers a credit review. But if it comes back lower, then we didn't waste time as I continue to negotiate with my landlord to get this deal done. Same thing here. Borrower is to deliver a review engagement prepared financial statement prior to funding that is satisfactory to the bank's credit committee. You're giving the bank the out, but you're also giving yourself some rope and time to keep the process moving along. Lastly, the borrower is to deliver a completed Phase 1 environmental report prepared by a recognized firm confirming the cleanliness of the property and no recommendation for a Phase 2 or required remediation activities. This condition precedent confirms to the bank that I'm going to get you that Phase 1 before you give me the loan and are truly exposed, and it's going to confirm that there is no environmental issues with the property. So let's not hold up the clock. Okay, so the last area of negotiation is reducing your equity check. And this is usually effective for buying a piece of real estate or buying a business. And so the best way to reduce your equity check, instead of writing 25% of the equity of the deal value in the form of cash equity, you can get vendor financing. Okay, so banks require borrowers to invest a certain level of equity in the transaction to show sufficient skin in the game. That's critical to their risk philosophy. You can't negotiate away that. Like, they need skin in the game. If I was going to give you money, I would want skin in the game. It's just only fair. So the best thing to do is to negotiate with the vendor and give them almost a second position lien on the property, on the business. And that way, from the bank's point of view, they have deferred equity that's coming in, and you don't have to write that cash for them. So to give you an example, for a real estate deal, banks will usually ask, anywhere from 20 to 30% of the total property value needs to be in the form of equity, with the balance coming in the form of a first mortgage. So to reduce the actual cash equity invested, you negotiate a postponed and subordinated vendor note, which will allow the bank to consider the VTB as deferred equity. So what does this mean? Just to slow things down here. So postponed means that there's no principal payment on the VTB, on the vendor financing, and it's also subordinated to the bank, so that the secondary lender, the seller of the property, or maybe it could be an alternative lender that comes in a second position, is subordinated in agreeing to the fact that the bank has priority on all assets first, fully covering their loan, and only after they're fully covered does the second position lender have any sort of protection or claim on the assets. So from the bank's point of view, they don't really care what's below them. They have full security on the property today. They have full protection on the total value of the property, and anything that's excess, well, then that would flow down to the secondary position lender. But from the bank's point of view, this is deferred equity. This is equity-like investment. And so typically you want to see that vendor note postponed, and that postponement is going to be anywhere from 2 to 3 years of interest only. It can't be amortized in conjunction with the senior loan. So typically what you want to do is you want the bank's loan, the senior loan, to be amortized right out the gate so that they're reducing their exposure from day one, while the vendor note is interest only and doesn't change for 3 years. So that in 3 years' time, the bank's loan has reduced by, three years of amortization. And from the vendor note's point of view, they have not received any principal payback, so that their risk level stays the same, but the bank's risk level declines. And they like to see that because that means, again, it's equity-like. There's no real seniority over them or a claim on their security. And then, realistically, the maturity date of that VTB needs to be after the bank loan. So if the bank loan has a term of 5 years for that senior term loan, what you want to do is you want to make sure that the vendor note has a term of 6 years. So the best way to do this, I'll walk you through an example, is I have a bank loan for a term of 5 years that's being amortized by 25 years because it's a property, okay? And so in that example, I've reduced the loan value by 5 years within that initial term. And for the first 5 years, the vendor note doesn't amortize at all, but in year 6, it begins to amortize moving forward. So realistically, for the first 5 years, the bank is the sole lender that's being repaid, that has security, full protection on the property. So they are very comfortable in lending to you in that regard. But obviously, you need to negotiate that with the VTB. So the VTB holder needs to agree to being subordinated and agree to being postponed through a standstill agreement, which the bank and the VTB holder will sign as intercreditors. And so sometimes sellers are not comfortable with that. They obviously want their money up front today, but in certain deals where maybe it's difficult to sell the property or get the value that they're looking for, you can say, hey, listen, I'll give you the value that you're looking for, but I need you to be patient on a portion of that deal via a vendor note. So in this example here, let's look at a $5 million property deal, okay? With some closing costs all in, this deal is going to be about $5.125 million, okay? So realistically, when you're going to go to the bank's going to ask for 25% of the deal in the form of equity. So realistically, they may give you about 75%. In this example, I just calculated it to be about 74%. So they come to you and they say, hey, listen, on that deal, day one, I'll give you $3.8 million. Well, the delta, the balance, am I going to come up with that myself? Am I going to come up with that $1.32 million myself? Or what can I do? Well, in this scenario, I negotiated a postponed vendor note of $500,000. And so, again, I negotiated where the term of the VTB is longer than the term of the senior loan. I negotiated it to be interest only for 3 years or 5 years. And I convinced the seller to sign a standstill and subordination agreement with the bank. And in that scenario, the bank now views that $500,000 not as a secondary loan, but as equity-like. So they would group my $825,000 in cash that I'm putting into the deal with the $500,000 in the deferred equity and view that as really, truly about 26% of the skin in the game, which clears their required hurdle to fund the deal. So this is a really effective way to stretch out your equity funds and amplify really the amount of debt that you can borrow. Because the reality is, say for example, I only had $825,000 in equity. I couldn't put in a dollar more. I don't have more equity, and I couldn't get this $500,000. Then, I'm just going to run the calculator here and just excuse me for a second. So that's 3.8 million plus my 825. So the total value is only 4.625. So 825 divided by 4.265 is only 19% of the deal. So in that example, I would only have 19% equity, which doesn't clear the bank's skin in the game requirement. So the bank would either ask for a very strenuous personal guarantee, or they would ask for me to put up more collateral in the deal, my personal home or something else, and which I'd obviously not want to do. So the vendor financing is a great way to stretch out your equity funds to amplify the purchasing power that you can. So, in summary, those are the 5 areas, and I'm going to give you some final thoughts when it comes to these negotiating tactics and how to apply them and when to apply them. So, I'm going to remind you once again, the first point is really important. Avoid negotiating the fundamental credit terms, right? The value of the loan, the total leverage of the amortization assumptions. Those are critical to the underwrite. And if you push back or if you start negotiating those things at the offer finance stage, all you're doing is delaying the deal because sure, okay, fine, we can look at trying to change this, but it's going to trigger a rewrite of the credit application. It's going to go back up to risk. It's going to go through all the approval levels, and it's going to waste a lot of time. And in most instances, they're going to come back and say, no, sorry, we can't do. As we said, this is the best that we can do. So don't focus on the fundamental credit terms, which are critical to the bank's risk level. Focus on the throwaway terms, things that are not material to determining the quality of your business. Adjacent fees, annual review fees, stuff like that. It's not critical to the business's underwrite. And therefore, the lenders are not going to push back, or it's not going to trigger a credit underwrite again. Now, private lenders are usually tougher to negotiate. So this approach, these tips and tricks are more effective with the banks, the credit unions, the A lenders, because obviously they're bigger institutions and they're not looking at this as it's a profitability discussion. Whereas with the private lenders, they typically have a private fund, and one of the core areas that they get their returns on are fees, and they really care about fees. And because private lenders are taking more risk, they're going to be really aggressive on the personal guarantee. They're going to be really aggressive on the interest rate. They're going to be really aggressive on the fees. So all 3 of those 5 things that I gave you, the private lenders are not going to react favorably, and they're most likely going to push back and say, no. We have the power here. You're coming to us because you're probably not a good business if you're dealing with a private lender. So we want this structure in place because this is important to us. So the private lenders are more profit-seeking traditionally than the banks, and so therefore you're going to have less wiggle room in terms of negotiation. Now, using ththese tactics works best when you're a new customer at the bank. If you're an existing customer, what are you going to do? Yeah, realistically, think about it. Like, you want a new deal, you want to expand your mortgage or whatever the case is, and you go through the process internally of getting more loans from the bank that you're with. Well, they give you what they can give you, and all of a sudden what are you going to say? Well, okay, I'm taking my business elsewhere. Okay, well, that's going to be a 6-9 week process. You're not going to take your business elsewhere for a $5,000 reduction in your commitment fee. So realistically, the leverage that you have when you're negotiating these smaller throwaway items, it's a double-edged sword. If you're already with them, they know that the inconvenience of paying $5,000 on a commitment fee is not going to make you leave the bank. So they're most likely not going to be as flexible. On the opposite end, if you're a new customer, from a commercial banker's point of view for their bonus plan, new customers are a big portion or big driver of their compensation. The bank wants to see new customer acquisition, and they will compensate the relationship manager more for that. And in addition, most banks are going to look at the total value of your relationship. And you may be bringing your day-to-day banking, your credit lines, your wealth management business, your personal banking, whatever the case is. So they're looking at not just winning the term loan value of the business, but all these other ancillary services and the relationship in general. And they're going to value your relationship much more. So if you're a new customer moving to a new bank or dealing with a new potential bank, you're going to have much more leverage to push them around and say, hey, give me that savings on the cost and I'll bring my business over. Okay? And then the last thing is, this is just a quick comment. I've given this speech a few times to a few private business owners, and they usually say, great, I'm going to apply all 5 of them. Okay? Don't apply all 5 of them. Pick and choose areas of the term sheet that you feel comfortable with negotiating, but always remember, if you have a term sheet in your hand a bird in the hand is worth more than two in the bush. So don't be too aggressive, because some banks will react negatively, or you'll get a reputation as being a very tough negotiator. And so the relationship manager will not want to deal with you, or will not give you as much leash. So pick and choose your areas, focus on the commitment fees, or focus maybe on the interest rate pricing grid, but don't push back on all of those areas, because all of a sudden you push back on that and the relationship managers will be like, whoa, this guy is aggressive. Like, oh, I don't want to kind of deal with him on a day-to-day basis. I don't want to fight for him as much. So kind of pick and choose which areas you want to negotiate. But if you're going to go after all five, just realize you're going to be seen as aggressive, or maybe your deal is too small, or you're not even that good of a borrower and they're not going to fight for you. And all of a sudden, you're going to lose total interest from their point of view, and then you've lost your leverage there. So just pick and choose your areas. So hopefully you found the video helpful. If you have any questions, obviously just comment below, or you can reach out to me over LinkedIn, or reach out to my email at robleecapital.com. And if you have any questions in terms of negotiating with lenders outside of this video, then just reach out to me directly, and hopefully I can help out. I do this on a day-to-day basis. I help a lot of clients in the lower mid-market space in Canada negotiate with their banks or look at different lending options. So just reach out, and happy to kind of connect with you guys. And as well, please like and subscribe to the channel for more videos, and have a great day. Thank you. Bye.